How wonderful to see all the participants here. Welcome to our panel focused on ESG and CSR developments in the asset management industry. I'm Jennifer Marietta Westberg, and I'm a principal at Cornerstone Research. So environmental, social, and corporate governance topics have really garnered increased attention over the last several years. And in terms of somewhat recent activity, I just want to note a couple of items. So first, I am a member of the SEC's Investor Advisory Committee, and that is a committee that focuses on issues related to investor protection and similar topics. On May 21st of this year, that committee issued a high-level recommendation to the SEC that they consider certain issues related to ESG disclosures. The recommendation was not prescriptive, so at a very high level, but among the topics that were discussed in the letter were things like whether ESG disclosures provide investors with material information that they need to make investment and voting decisions, whether the SEC thinks a framework should be provided to issuers to guide disclosure in this area, and a consideration of how an ESG disclosure regime could affect the flow of capital to US issuers. That recommendation is on the SEC website if anyone is interested. And even just in the last week, I noticed articles coming out of the media on this topic in several areas. I'll just note two of them. On Monday of this week, there was news that the Department of Labor has sent enforcement letters to registered investment advisors, asking them to answer certain questions about their use of ESG funds in retirement plans over a 5-year period. And this is affecting multiple different areas of the economy. There have also been recent announcements that law firms are launching new teams to focus on helping corporate boards and management teams navigate ethical investing and related legal issues. So with that short note on what we are seeing discussed publicly now, let me introduce our panel. So we have 3 great panelists. Diederik Timmer is Executive Vice President at Sustainalytics, an independent provider of ESG research and analysis for the global investment community. We also have Hans Christensen, who's a professor of accounting and the David G. Booth Faculty Fellow at the University of Chicago. Hans's research studies international accounting harmonization, debt contracting, transparency regulation in financial and non-financial markets, among other topics. And finally, we have Laura Starks, who I'm sure those at the University of Texas already know. She's the Charles E. and Sarah M. Say Regents Chair in Finance and the Co-Executive Director of Social Innovation at the Macomb School. She's also an Independent Director for CREF Retirement Accounts and TIAA CREF Mutual Funds. In terms of our process for this panel, each speaker will provide approximately 10 minutes or so of introductory remarks. We're then going to turn to cross-panel discussions, and we're happy to take questions for participants. There's a chat function here, so if you'd like to just enter your question into the chat, we will review those and select as many as we can throughout the panel. So I'm going to turn it over to Diederik to get us started.
Thank you very much, Jennifer, for the introduction, and hello, everybody. What I would like to do today is to talk about sustainable investing and ESG ratings. And I first will talk more about the interest and the growth of ESG, then about the why and the reasons why investors are looking at these factors and why they're creating these products, and then move towards what is some kind of information or sets of data that investors are using to understand the sustainability performance of companies. If we go to the next slide, Jesse, thank you. I think across the board, you're really seeing investors showing strong interest in sustainable investing. These are the numbers coming from a study by Morgan Stanley, and the data is as of late last year. And what you're seeing is that across the board in the general population from 2015, 70% of the investors voice having significant interest or some interest in sustainable investing. And if you're looking at a subset of that population, the millennials, then it's currently up to 95% of the individuals being interested in ESG, sustainable or responsible investing. So I think across the board, we're seeing a significant interest, but the big question, of course, is what are they really interested in and how is that driving? So if we're going to the next slide.
Can everybody see the slides? I don't see any slides. Is that just me?
I'm able to see the slides.
I can
That's
see the
weird.
slides.
Yeah.
Okay.
So if you look across the globe, and what has that really meant in terms of assets and where ESG, so environmental, social, and corporate governance information is hitting the investment process, you're currently seeing that globally, $1 in 3 invested by professionals incorporates ESG factors in one way or the other. For some, it's a signal that they just use to get a bit of insight in the risk or return profile of an investment they could be making. For others, it's really used to create very sustainable portfolios or portfolios that are having the objective of creating significant social, environmental impact. So there's a huge variety across the board, where you're seeing a significant growth over time, but you're also identifying a significant global movement towards incorporating ESG factors. And even if you would look at a market like the US that I would call traditionally a more skeptical market, this diagram on the right-hand side shows the inflows into ESG or SRI funds at this moment in time. And what you're seeing is that at the end of 2019, around 10.5 billion of new assets have flown into SRI or ESG labeled funds. So this is really coming from a significant interest from the investor, and it's and they are allocating their investments to funds that take ESG or sustainable investing seriously. If we're going to the next slide, there are mainly two drivers for investors to look at ESG or sustainability information. The first and an important reason is that they realize that investments have an impact on the world, on the real economy. And whether it's now positive impact or management of negative impact that investors are having, many investors are seeking out ESG insights and ESG signals into the investment process because they believe it makes a difference for their investments. The other main rationale for incorporating these factors into investment decision-making is that they see it as relevant for their investment thesis. So they believe that ESG risks are financially material, which means that it can hit their risk profile or their return profile of their investment portfolio. And they're looking at ESG factors to really contribute to that. And there are some strong signals and some strong academic as well as empirical evidence that demonstrates that there are many events and incidents where it is indeed material. If you're looking at the diagram here on the left-hand side, you see that in 2018, there were 40 events with a total value of, with a total loss value of around $400 billion that hit the corporates based on, let's say, a standard pricing index. This is a really significant one. And if you're looking at examples, for instance, the floods across the US during 2018 resulted in a damage of around $6.2 billion. But there are many other incidents. I'm sure that you see the headlines as well, where these incidents have a major impact and create significant losses for a firm. Other areas where we're seeing investors significantly focus is, for instance, on the failure of corporate governance. So a good example here is WeWork's pre-IPO poor governance practices have really resulted in a significant loss. But for instance, if you're looking at the events with Volkswagen around their emissions and the scandal around that, these shares dropped 37%, and also this car company, as well as many others, haven't really recovered appropriately from the losses that they have gained. So investors are increasingly seeing that materiality. And also, for instance, now during the global pandemic, for instance, it's a really good sign that there's a global systemic risk coming from environmental, social, and governance factors. And it means that this will have real market impact. And investors are seeking to identify that market impact at an early stage so that they can mitigate and manage for that as they invest their portfolios for the longer term. So if we go to the next slide. just wanted to highlight very shortly what does Sustainalytics now really do. So the firm I work for is a part of the Morningstar organization, and what we provide is research and ratings on over 10,000 companies worldwide. And what we provide is an overall risk rating where we identify how well a company performs in terms of sustainability. And this data and the rating is based on publicly reported information coming from companies. We collect that information as much as we can. We then also collect a lot of information coming from third parties. We then aggregate that information, structure it, and monitor it. And we then put it into an indicator context where we try and analyze the performance of the company, not just to its own historical track record, but also to its industry peers. And we then make assessments on the performance of the organization based on an indicator level and ask the companies for feedback on our findings. And this allows us to put some context to how well a company is performing when it comes to sustainability. The methodology that we have in place looks at two dimensions of sustainability and of ESG risk. The first component is that we look at the exposure that a company has in terms of sustainability risk. So for instance, where are they investing? What type of activities do they have? How do they organize their supply chain, etc.? And these are often related to sectoral challenges that an organization has. And you can imagine that the issues that are important for a financial services firm are very different than, for instance, for a chemical firm. So that's where we look at exposure. Then based on that exposure and to what factors a company is really exposed to and what the magnitude also of that exposure is, we then try and measure the management component of this. And in terms of management, you should look at, for instance, measures that an organization can take to mitigate and to manage those risks and those exposures that they're having exposure to. So for instance, you could see a company developing policies, management systems, and implementing those management systems, and then reporting also transparently about how they're doing. When we equate those two, the result is an overall ESG risk rating where a company with a high score means that the company has a high risk and a high exposure and poor management with respect to ESG factors. And investors like using this data because, and we'll talk about that more, and I'm sure there will be lots of questions, because investors struggle to understand the breadth of data that's available coming from the corporates. They struggle to also understand the interlinkages between the various data sets that they get from companies. And then overall, they have a struggle also in terms of making interpretations on what is now really material, what is now really important, and what is probably less important. Investors use companies like Sustainalytics, but also several others, to buy ratings on these companies so that they can more easily slice and dice through this data, but also have access to structured data sets that helps them to do their own analysis, also on an indicator and data set level. These data sets allow the investor to compare performance of companies over time, as well as to sector. And what is new and what is a real innovation in the industry at this moment in time is that it can also allow the investor to compare companies across the board, so across an investment universe. So that means that you can compare a Facebook, for instance, the example here, with the risks that a company has in mining or in the financial services sector. This all with the objective of giving a tool to the investor to, in a relatively quick way, see how an ESG performance is, and then to drill down from that perspective. At this moment in time, we help around 750 institutional investors across the globe, which probably relates to about 1/3 of the assets that are related to ESG use Sustainalytics ratings in one form or the other. Now, recently, we also developed with Morningstar a methodology to assess mutual funds and other funds and products on their ESG performance. And what it does is an asset-weighted roll-up of the scores that we have at the security level, so at the individual company level. And it means that you can now compare not just companies with each other, but also investment funds. And you can look through a snapshot of a portfolio to see how well they perform in terms of sustainability. If we're going to the next slide. I wanted to maybe give a starting point for some conversation that I would like to have. And I mostly get two major questions when it comes to presentations around the work that we do. The first question is, what's really in the rating? And people that are following ESG ratings and the debate around this are increasingly picking up signals that there's a significant difference between the various ratings that agencies are providing, and that there's a very low correlation between the various ratings that are out there. And that of course poses the question, is there a quality issue? The answer that I would give to that is maybe twofold. The first is that the ratings that are being created, this is an industry that is relatively new. Our organization currently has around 700 people, but when we started about 15 years ago, we had a team of 40. So there's been a significant improvement over time of the quality of ratings that we're able to provide. And that's also in alignment with the quality of the reporting that we get from corporates. If you look at the reporting, for instance, from corporates about 10 years ago, only 20% of the S&P reported in a meaningful way on ESG factors. And currently that stands at around 90%. So the quality of the information is improving, and it also means that it allows for further innovation, and that innovation results in differences between rating providers. So coming to the second question on this front, is there therefore a uniform and a lack of standards among the rating providers? I think the answer therefore is a clear no. Different rating providers measure different things. Some measure impact, other measure risk. Other organizations do it in different ways, but I don't think that necessarily means it's a bad thing. What is really important is when you look at these ratings is to really understand what they're intending to measure and how they go about it, and to assess the quality of the signal that you provide, that you're reading, the rating itself or the underlying data in its own merits with respect to what is intended to measure. The second question that I often get is related to financial materiality. An investor has an objective, of course, of creating risk-adjusted returns for the client that are diverse and diversified and are in alignment with the financial objectives that the investor has set. That is the objective of an investor. Many organizations rely on looking at what is financially material to assess the investment performance and to predict also what share prices are going to do. And there's a big debate whether ESG is financially material to the investor and for the analysis process. And that whole debate, in my view, I think is an interesting one, but I would like to put out one statement here, and that is, at this moment in time, I believe that there's almost no investment team in the world that hasn't looked at ESG factors one way or the other, whether it's now that they invest in the mining sector, where the exposure that they have through their operations is material, or if they invest, for instance, in the financial services sector where there's been major scandals, which we would classify as ESG. I think in the end, it's the investor that decides what's material, and that materiality, therefore, is decided by the investment professional. And I think it's therefore not an argument not to look at ESG factors, because if they deem it to be interesting and relevant to them, then who are we to argue that it isn't? Then the second is that typically you see a lot of these SRI or ESG funds that are excluding companies from their investment portfolio. And that's one of the ways to look at incorporating ESG factors in the investment decision process. What we're hearing is that companies or investments or investment teams that divest from really large numbers of companies create different types of portfolios that respond differently in different markets. They just have different financial characteristics because they're not built like any other. And that means also that you will get different performance at different moments in time. And you can't expect that they would have similar performance and similar responses to market developments as well. I don't think that's necessarily in breach of a fiduciary responsibility or the responsibility of the investor. I would argue that that's actually part of what the investor is doing, creating better invested portfolios and using better ESG insights in their investment decision to make sure that they perform well. So with that, I would like to round off by saying, I think there's a significant interest coming from investors. You're seeing that in a huge inflow in assets going to products and in investment funds, but also in securities that perform really well. There's an increasing confirmation that ESG factors can be material to the investment process. And increasingly, you'll see a need for better data and better tools. And maybe that's also a good segue to Hans, your presentation. So thank you, and happy to take any questions.
Okay, we'll do the questions afterwards, right? I think. Is he here?
That's correct. Yep.
Can you see my screen now? Can you see my slides?
Yes.
Excellent. Perfect. Thank you very much. As Jennifer said in the beginning, I'm an accounting professor. Almost all my work is on regulation, and specifically, most of it is on disclosure regulation. So what I'm going to do now is I'm going to talk about research opportunities, and so within sort of disclosure regulation in this ESG field, or sustainability, as I'm going to call it. But there are many different words for this, of course. So a lot of the arguments that I'm going to talk about are from a report and associated academic article that I've co-authored with Lucy Hale from Wharton and Christian Lloyds from here in Chicago. I'll give you a reference in the end if you want to look at it. This will of course be brief because we don't have that much time. Or I don't have that much time, at least, out of this. So let me first give you a little bit of background to this. So there's recently been a major push over the last couple of years for sustainability reporting and for making it mandatory, right? So this, of course, builds on this idea that a lot of people think that that's a critical step in potentially making firms more socially responsible, or alternatively that we think this is a very value relevant information, right? So just one example is actually one of Dietrich's colleagues over here, the CEO of Sustainalytics, that basically has this interesting article from the Financial Times where he's arguing that, well, time has sort of passed beyond voluntary disclosures. We need a mandatory framework. And in fact, he goes as far as saying we need one similar to what we have in financial reporting in IFRS, so an international set of standards. So those that don't know what that is, that's basically financial reporting standards that firms follow. Most firms outside of the US follows. Okay, so there are also several standard setters that are proposed solutions. GRI and SASB would be examples of that. So why is it that people suggest disclosure as opposed to some other regulation? This is sort of not unique to this particular space. There's many areas such as consumer protection, healthcare, and political campaign contributions where in recent years, policymakers have gone for disclosure as opposed to more traditional regulation where we tell companies what actions to take. And typically, the areas where this is chosen are the areas where it's sort of difficult to come up with the right solution for different reasons, often partly political. So in this particular space, it's often very difficult to agree exactly on what the right action is. So if you think about global warming, there's all these complications between developed countries and developing countries that are hard to solve. And then disclosure regulation is seen as sort of, it's not as intrusive because we're just saying you have to disclose what you're doing. You don't actually have to take any specific action. And then the other factor that's related to that is that it's often very, very hard to argue politically against disclosure because most people are just for transparency. And of course, the whole idea is that if we got firms to report on their sustainability performance or ESG, different characteristics of ESG, then it will be easier for stakeholders, investors, but also consumers or other groups to monitor firms, potentially pressure them. And then the market could sort of solve the whatever difficult things that we can't figure out with regulation, but just by pressuring the firms. So the question is this a good idea or not, right? So how could we, that's of course a hard question to answer, but how can we as academics potentially contribute to this debate? Because I think we can do it in many ways. So first of all, I want to say that's relatively, part of that report is a very extensive literature review of what we know from academic research. And there's relatively little research on reporting mandates. So most of the research focus on voluntary disclosures. And of course, voluntary disclosures, first of all, they don't tell us so much about a mandate where all firms have to report in a certain way, but it also has a lot of endogeneity concerns, right? Because it's a choice to report. And in this particular area, it's even a little bit harder to use for research because there's both a voluntary choice typically to do something sustainable or some CSR activity, and then reporting on it is a second choice, right? So you have this double layer of endogeneity that makes it hard often to certainly disentangle disclosure from activity because that's almost certainly related, right? So of course, mandatory disclosure regulation also has endogeneity concerns, but it's often a little bit easier to alleviate those concerns through maybe regression discontinuity design or some different diff where we can find a reasonable control group because at least the decision isn't done at the firm level. Okay, so the challenge we have about talking about this broad idea of having an IFRS of sustainability reporting is that that it's not there's such a mandate doesn't exist. But what we do have is we have a lot of initiatives, especially recently, where it's more limited. It's typically one specific industry, or maybe it's just for listed firms in one area or something like that. So it's more targeted than a whole reporting framework. But there are, according to this report that recently came out, it's called Carrots and Sticks 2020. If you Google just that name there, you will get onto a website, and that website has all the regulation across the world that they've been able to find. 600 different kinds of regulation, right? It's not a broad reporting framework, but it has this flavor of disclosure in this ESG space. And the good thing is there's lots of variation, right? So there's variation in where it's disclosed. So is it in regulatory filings such as annual reports, or is it in separate reports or websites? What is it mandating? In terms of topic, is it CO2 emissions? Is it employee safety? Is it human rights? In terms of enforcement, are we doing this? Are the countries doing it in securities regulation, or is it some other piece of regulation it's attached to? And who is enforcing the regulation? And then we also have a lot of variation in which firms have to comply. Sometimes it's a segment of a certain exchange. Other times it may be all public firms, but not private. And sometimes it's just all large firms or all firms, right? So a lot of variation, of course, also variation in what existed before. So if you look here to the right here, this is a figure from that report. One of the reasons we don't have much research is that most of these initiatives are quite recent, right? In the last 5 years, most of them have come about. And if you go on the website, you'll get plenty of ideas for different settings that you could potentially look at. Of course, I'm not suggesting now that we should all go out and do this and then have 600 different studies that look at each piece of regulation, right? We need to think carefully about what each setting could potentially teach us. Some might be better than others. Think about sort of what the trade-offs are. So what I'm going to do now is I'm going to talk a little bit about why might it be different to mandate sustainability reporting relative to financial reporting. What could be different, right? So when we did the literature review, it included also sort of an economic analysis of what might happen. It's of course hypothetical, but one thing that we sort of quickly could say is that it's probably true that many of the findings that we have from financial reporting or other types of reporting will probably be true here as well. So it's probably true that better information and more consistent information across firms is going to create less information asymmetry between manager and investors, and between among investors and so on. And that's likely to have a direct effect of maybe increased liquidity and maybe lower cost of capital and maybe improved capital allocation, that type of thing. But there's sort of other effects that might, or things that might complicate it in this area that I think it could be interesting to sort of try and understand better. So one of the things in the report, we have many things we discussed, but one of the things I think that is true is that sustainability reporting tend to have much more diverse set of users, right? So as an example, my mother is a nurse, just retired, but she's a nurse. She doesn't really care about revenue recognition or insider trading regulation, but she does care about human rights and global warming, right? So you get a much broader group of users, and typically also, I think, a broader group of a broader set of things that people use it for, right? Maybe not just investment decisions. So you could imagine consumers being more interested than they are in revenue recognition, for example, or insider trading regulation, activists, different kind of NGOs being interested in this. And of course, that means we're introducing a lot of users with different levels of sophistication and different interests. How might this complicate things? And I want to say, it's not that I'm against it. I'm just trying to say what could be some of the things that's going to be different from what we see in financial regulation or securities regulation more broadly. So the two things I'm going to focus on, because I have limited time, is going to be the politics of standard setting. And then I'm going to talk about how do we determine, if you were a regulator, what is material information and who are the information users that we think, who do we think are going to use this information? So there's not going to be any specific research ideas, because then I would probably have done it myself, but just some considerations of how it might be different and what might be interesting to understand in this specific setting. So if I start with the politics of sustainability reporting, so the group, as I said, of users are probably broader, and the argument, and that's probably going to mean that the arguments that we see in the political debate or the debate over the regulations are going to be somewhat different from what we see when we talk about financial reporting, for example, or insider trading regulations, something along those lines. And it's also maybe going to be a little bit more political, right? Even financial reporting becomes political, but here you could really see scope for some political, different kind of political arguments come in than what we usually see in this type of regulation. So I'll just give you a quick example. Conflict mineral disclosures. That was basically a disclosure regulation that was attached to the Dodd-Frank Act back in 2010 and required firms to give information on where they source minerals from. And the idea was to try and get firms to not source them or source them responsibly from the DRC, the Democratic Republic of the Congo, which is not very democratic. But around there's been a big war. More than 10 million people have died, right? So it's a big issue. And it was sort of an idea to put pressures on firms to not buy minerals from there, which could then maybe fuel the conflict. If you look at the letters that came in when the SEC tried to implement it, it's about 2/3 almost are sort of from unusual groups, right? So in the general public and NGOs. And generally, all of the letters, I didn't look at all the letters, but all the letters I looked at is basically in favor of the regulation. And the argument is typically about how the conflict is really bad, how this is creating human cost, like in this area, cost to humans, right? Then you have a little bit more than 1/3 that comes from more the usual suspects when it comes to securities regulation, such as businesses, trade and industry organizations, and the typical ones that write common letters. And they also generally are not against the regulation because it's hard to, or against the intent of the regulation, that's tough to be against. But they keep pointing out to reporting cost, right? So you can imagine the difficulties it would be for a bureaucrat to sit and weigh these off against each other and try and come up with a compromise between them. So some of the questions I think are interesting, but they're broad questions, is who actually would participate in this regulatory process, and how might that be different from, say, typical securities regulation, right? Does it depend on the topic or the channel, right? Does it matter who participates for how the regulation is written? And if they do participate a lot, do we then see that it's maybe less useful for investment decisions if we think more about other issues than necessarily what an investor might care about directly? And then, of course, a big issue would be, how do we think about cost-benefit analysis in this particular area? Because if the objective of the regulation is partly to get firms to behave in a more socially responsible way, are we then going to take into account the social cost of conflict, for example, in Congo or something like that? That would be a tough, or CO2 emissions or something like that, which would be a tough consideration. So I don't have so much time left, so I'll just skip to this materiality, which Diederik also talked about. So I think, so materiality means sort of, is the information important for decision making, right? Is this something, and in accounting and in law, it's sort of, it has to be something that could move price or something, otherwise we don't require firms to disclose it. So that's a little bit difficult, I think, it's always difficult to assess, slightly harder probably in this space. One reason is that very often it's not expressed, ESG information is not expressed in monetary units, and it's often a very long horizon. I know Laura might, in her survey, it looks like investors think some of the issues are actually earlier than I would have thought, but it's a long horizon. That's hard to objectively say, is this material or not, because there's so much uncertainty around it. Then it's also very likely that opinions are going to change quickly in this space because it's going to follow media and so on. Yet regulation and standard setting tends to be a slow process. So it's not so clear that regulation is going to be able to sort of pick up on these quick things that suddenly people care about. And then I think another issue is that some of the issues that people care about are not really financially, they might in themselves be financially immaterial, right? So an example could be these drinking straws debate that started a couple of years ago, where people thought that was really bad for the environment for various reasons. We shouldn't use drinking straws or offer them to customers. Well, that's probably not financially material to most firms directly. But if stakeholders care about it, then, and maybe will boycott a business for it, then suddenly it is financially material, even if the item itself is not that economically material to the company. So one approach that we could take is that we could say, well, we only care about what investors care about, right? But the problem with that, of course, is that if investors care, because of how stakeholders are going to react, then it's not clear that that's going to limit it very much, right? Because any stakeholder that could impose cost on the firm, whatever they care about, whatever might cause them to boycott the business, an investor would care about, even if they don't care about the topic specifically, but care about what stakeholders are going to do, right? So even limiting to investors, it's not clear it's that much limiting, right? And the other challenge will be that it could be that once something is disclosed, then suddenly it does in a way become material, because the problem, of course, is even if you limit it to investors, anyone can look at the information if it's publicly available, right, and could react to it. So it could be something that was kind of immaterial becomes material because we're now putting it out there. Briefly here, because I can see I think I'm taking a bit too much time. I think it'll be interesting to study sort of which user groups use this information, and does it matter whether it's disclosed in regulatory filings, such as annual report or websites, and what type of information. I think it'll be interesting to see how non-investor information users and also investors information users use it, whether they use the information, how does that affect firm behavior? So does it get them to invest more in sustainability, which might be our objective? Does it have some unintended effect? Maybe it will cause some firms to delist if you only do it for listed firms. Maybe it will cause some firms to exit certain markets that has a very high sustainability risk, right? And it's not clear, maybe, but it's not clear that if you imagine that only US firms are regulated and the activity moves to maybe a developed countries, that necessarily we're going to be better off in the aggregate, right? So that type, it could also be disclosure behavior, right? That you see more boilerplate disclosures, and that could potentially affect investors' usefulness of the information. Yes, okay. So I think I'll skip the last point so I don't take too much time here, and just say this is the report that I put up now, which has many more arguments and many more research questions, and you could take a look if you're interested in this aspect. And then I will turn it over to Laura.
Laura, you're on mute, so just checking.
Thank you.
All right.
Hopefully this is gonna work. I've changed computers twice, so because my computer was acting up. So hopefully this is going to work. So I wanted to talk about again, to follow on with talking about disclosure, but in this case, and the particular type of ESG disclosure, in this case, to focus on climate risk. And I think this fits in because it's looking at, this is some research where we've looked at investors' preferences about disclosure on climate risk. So we did a survey of 439 institutional investors worldwide. These are primarily some of the largest investors worldwide. So they're the ones that could actually have more effects on more pressure on companies to disclose. And we asked them a number of questions, and I'm just going to highlight a few of them. But we asked, one of the main questions we asked was, in terms of climate risk disclosure, how important did they think that was compared to disclosure on financial information? And you can see from looking at this that 79% believe that climate risk disclosure is at least as important, and some of them even believe it's more important than financial disclosure. So they think this is an important issue. Now, climate risk disclosure is voluntary, and when we think about voluntary disclosure, as Hans was talking about, there's, there are questions about it. There must be some kind of cost. Otherwise, why wouldn't all companies just go ahead and disclose it? And so what we found was that the investors who thought that climate risk disclosure was important were those that were larger, they had more assets under management, those that had a higher share of their portfolio invested according to ESG principles, and those that believe climate risk to be more financially material. there is a task force for climate-related financial disclosures that came out with recommendations that they were appointed by the Financial Stability Board. And they came out with these recommendations in 2015. So this is 5 years ago. And their recommendations were that that companies should disclose their climate-related risk and opportunities and the impact on the firm's businesses, that they should disclose how their firm's governance structures deal with climate risk and the opportunities that arise from them. They should disclose how firms identify, assess, and manage climate risk, and they should disclose which metrics and targets firms use to assess and manage carbon emissions. There are still not a lot of companies that are using, following the recommendations of the TCFD. And so we asked the institutional investors whether they were planning to engage or already had started engaging their portfolio companies to report according to these recommendations. And we found that 59% said yes, 24% said they don't know, and 17% said no. And we also found there were characteristics about these investors that they were more likely to engage if they had a higher ESG share of the portfolio, if they believed climate risk to be more financially material. And again, these were worldwide investors if these investors were located in countries that had higher social norms about the environment. And so the ones that were, and it tends to be European countries, not as much in the US. If they have higher social norms about environmental issues, those investors that were located in those countries were more likely to engage their portfolio companies to report according to the TCFD's recommendations. We also asked investors about their own disclosures and whether they plan to report the carbon footprint of their portfolios, and 60% said yes, 24% said no, and 16% didn't know whether they would or not. And again, we found that those who report or plan to report were larger, had a higher ESG share of their portfolio, and believed climate risk to be more financially material. We also, so that was our survey. We then wanted to look at, again, this issue of whether firms would be more likely to report on a climate issue if they had certain types of institutional investors as their owners. And just briefly, what we found was that they were more likely to disclose their carbon emissions if they had more institutional investor ownership, if they had more foreign institutional investor ownership, and if they had more institutional ownership from countries with higher social norms toward the environment. And that was both the local institutional investors as well as the foreign institutional investors. So our conclusion is that investors care about the disclosure for information on climate risk, and that as a group they value this information, but there must be some kind of costs that are preventing the firms from actually following through with this disclosure. So there's suggestions that maybe there should be some regulatory response, and the United Kingdom already has demanded that firms follow the TCFD recommendations. There are a number of research questions that exist on ESG risk disclosure, and these are just a few examples regarding climate risk. For example, what's the effect of institutional investor and regulatory disclosure initiatives on the trading and value of companies with substantial carbon exposure? Another question that would be interesting to understand is whether the disclosure affects how investors differentiate between other characteristics of these firms. So are all firms with the same carbon exposure treated the same if some disclose and others don't? Does shunning make a difference, as in the sin stock research? Do investors shun companies in terms of both the climate risk and the disclosure? How does it affect the tracking error of the investors who do shun? Are they, when they're negatively screening out these companies? And then another question is, how do investors engage firms on carbon disclosure? Do different types of engagement matter for the disclosure and firm value? So I will stop there.
All right, thank you, Laura, Diederik, and Hans. So we have received a few questions, and I'll just go down the list. Not everybody on the panel needs to respond, but please jump in if you have thoughts. So first, we've had some questions about what's in the ratings, Diederik. And so you mentioned that it's very important for investors and users of these ratings to understand what the rating means. And one of the questions is about whether users of those ratings have the ability to do that, given that obviously they don't know precisely the calculus that underlies each of these firms' methods by which they put out the ratings.
Yeah, I think that's a really good question. So let me start by saying that transparency by the rating providers is a best practice. So I think you could argue that it's really important that a ratings provider that puts together ratings has a responsibility to disclose information clearly. I think there's also best practice. I think you might have seen that a lot of the ratings providers are making their ratings publicly available for free. So we have it on our website, MSCI is on the website. I think others are following soon as well. And I think that gives important accountability and responsibility as well to the public. I think when our users access our information, they can actually deconstruct our ratings and see it fully transparent down to the full calculation. It's just that we don't make that publicly available. That's really for our customers. And in that end, we are an organization that is working with customers, and we don't make everything available publicly just because of, first of all, the complexity that that brings, but also because you do want to protect some intellectual property as well. Also, our clients will have a full methodology document, which is quite a handbook. I think it's about this thick that highlights it. But again, it results also in a ton of questions that we're having. So maybe to respond to the question directly, I do think that there's a lot of information available, but typically it's for customers. And I would recommend when you use data to really ask the provider for providing the detailed methodology as well as the detailed calculus for how they come to their scores.
All right, thank you. So let me ask a follow-up question about industry and its relation to reporting in this space. So one of our participants, I think, brings up a great question, which is, won't some of this information be more useful depending on the industry that you're looking at? And Hans, maybe we can start with you. I don't know how much the research has looked into this. So this participant wants to know, is there a way to tell on an ex-ante basis how useful ESG reporting will be in certain industries? And Laura, maybe you have follow-on thoughts as well.
So there's definitely research on what, so basically the approach that SASB uses to standard setting, actually there's a participant here that could explain it a lot better, Jeff Hales, but is based on industry, right? Where they try and go in and say what's material. And then there is research consistent with defining that within an industry is a better, it will be different things that matter in different industries, basically, and that's also what the stock market seems to be reacting to, right? So it's like, it's those issues that are material in your industry that seems to be correlated with stock prices more than these other issues, basically. So there's, in that sense, there's evidence on it. I don't know if that answered the question, but.
It looks like yes, we're getting a thumbs up. Laura, do you have any additional thoughts on that?
I was just going to add, and Diederik can explain this better than I do, but the ratings providers have different scoring methodologies for different industries, so that they tend to be industry specific in terms of if you're comparing ESG scores, you have to control for industry. I mean, this is an example. Tech firms tend to be the very highest ESG scoring because there's not a lot that affects them.
So maybe I can add one thing to that. And I think you bring out a really important point. It relates to sector. But in the newest research methodologies that are coming out, it's not just sector, but it's actually the geographic location where the firms are, not just with their operations, but with their sales, with their supply chain, for instance. That's material also, depending on, you know, how they are. It also relates to their activities. For instance, where in the supply chain are they? And often they're classified within one sector, but some are at the beginning of a supply chain and others are totally at the end, which also has a different impact in the span of control that a firm has. You have direct influence over your own activities, but not so much over your third or fourth degree suppliers. So the newest research is really looking at accounting for this, and it means that you actually create methodologies that are specific for each company. That takes away some of the benefits of full comparability, right? Because you don't have the exact same data sets per company anymore, but there are adjustment methodologies done so that you could actually measure what is the exposure a firm has coming from all these dimensions, and then how well is a company actually prepared to deal with that, all with the objective of creating the best signal, not necessarily with the objective of creating the best comparability across the board. So I think that's where the evolution is coming. But I think it comes with its benefits, but also with its downsides.
Thanks, Hans. So let's continue with you for a moment. So we had a question about an example of the EPA website and some of the data that's available there. As you noted, a lot of this is reported on a voluntary basis. Are you able to talk about how you account for the fact that there may be bias in those who are providing the information and how you adjust for that bias in the ratings?
Oh, there's a really long and a really short answer to this, so I'll try and keep it really short. I think typically this data that's reported by companies is actually of really poor quality. Not only do we have major gaps in companies that are, for instance, not required to report, but also the reported data itself, we know is just not great. Even if it's sometimes audited, it's taken at times, like you mentioned, where it's not correct. I think they're looking at time series, but also comparing it across the board. And what we actually do is make adjustments for the self-reported data by companies, because we know from a historical perspective, or we know, for instance, for their peers, that this is not accurate data and it's incorrect. So there's adjustment factors that we're taking into place. Then maybe the last component is performance, and is only one of the metrics we use. Often we believe it's far more important to look at what are the policies and what are the management systems and what are the implementation areas that a company has. And we believe there's a lot of value in looking at that. It's a little more subjective, but we believe that actually across the board gives a good impression of how well a company does on this front. Probably more and probably better at maybe identifying the adaptation that a firm is having to addressing these emissions.
Okay, thank you. We have more questions coming in. So both Jeffrey and Aluna have another question for you, Hans, which are tied together. So, and you sort of did an on the one hand, on the other hand, about whether disclosure would be beneficial in this space. So the follow-on question from Aluna is whether the rulemaking process concerning these types of disclosures is related to the extent to which regulators are competent in their ability to judge the sophistication of these markets and the power of aggregating this information and whether it will have an impact. So I think people kind of want you to call it one side or another, and I know as academics, we generally don't like to do that.
I think my presentation maybe come a little bit out on the negative side, but that's because usually when I'm on a panel or something, everybody else is like super pro, let's do this immediately, right? So I'm just trying to say that it's a little, I think it could be a little bit complicated and slightly different from how it is to do financial reporting, for example, or other types of regulations. That's kind of what I was trying to say. And it could be interesting to try and understand, is this actually a serious issue or not, right? I think it would be very interesting to know whether a regulator is actually able to do this better than the market and the market pressure they can put on it, right? Are they able to, so for example, not to talk only about SASB, but like, are they able to say what is material and predict it sort of, right? Because if you think, if I'm right in my argument, I don't have any evidence to support it, but things are changing really quickly in this space, you know, of what people care about. Maybe I'm wrong about that, but let's say that's true. Then is a regulator really able to sort of come up with a set of relatively principle-based requirement? It will have to be quite principle-based, which will be connected to Dietrich's point. Then that the cost of that, of course, then you can target it to the firm, but it's going to be sort of less comparable probably and easier to do boilerplate language. if you do it sort of very abstract, but if you do it very concrete in what it is you have to disclose, then the question is, can a standard setter actually sort of say what it's going to be with, what are people really going to care about, right? And can they adjust quick enough when opinions change, for example? I think it could be challenging. It's also challenging in financial reporting, but I think it's potentially more challenging in this particular setting. I don't know how you would study that, but that would be super interesting if somebody could write a paper on that.
Well, let's talk about writing papers in this area. Laura, you brought up several potential research questions. And I just wanted to ask if you had views on the appetites of journals for these topics. So clearly you're working in this space, Hans is working in this space. Are the research questions that you put up also sort of supported by where you think the journals have interest as well?
Yes, the journals have really increased their interest. The Review of Financial Studies in March had a special issue on climate finance. The Management Science has a call for papers for a special issue on ESG. And so there's a lot more interest than there used to be. There seem to be, and there seem to be increasing number of papers in the area as well.
That sounds great. Hans, do you have anything to add?
Yeah, I know AOS, but that's not so, it's more famous in Europe, I think, but they have a special issue out in accounting on this issue. But I know that there are multiple papers under review at JAR at the moment that look, for example, at how does disclosure regulation, one of them look at that, it's by Saurabh, is it Tomar, his last name? I actually forgot. Anyway, basically that looks at how does disclosure regulation in this CO2 emission space affect how much CO2 they disclose, that are actually emitting, right? And there's several other papers that get in this CSR space. Of course, there are many submitted as well. So I think that there is an interest in it, for sure.
Oh, that's good for all these students thinking about working in this space. So our last question is whether you think there's a role for auditors in all of this. Have any of you thought about that and have comments?
So yeah, I mean, I think, so that's of course, it's also one of the challenges I didn't pick out in that report I talked about. There is you can like search for auditor, you can see what we sort of came up with there. I think there's definitely a role for sort of having the private sector partly enforce it, right? It's gonna be tough, I think, to enforce this, both for the private sector in terms of auditors doing it, because it is a little bit different skill set potentially. Imagine that you have to figure out if you have child labor in the organization. You don't have like double entry bookkeeping to figure it out. You need a different kind of system, a different kind of controls, as we would say in accounting, to figure that out, right? And it's not clear that it's a CPA. You want to do that. You might need somebody with medical expertise to figure out the age maybe in a certain country or of employees, right? So it could be, I think it could be quite challenging to do, but there's definitely a role for certification, I think, in this area. I think the same challenge would be there for the SEC. If you put this under the SEC, I mean, how are you? It's a bunch of lawyers, right? Some accountants and economists and stuff. Are they gonna? It could be. It's quite different, I think, from how they're enforcing things now, potentially.
Can I make a suggestion though there? I think we spend a lot of time talking about really large volumes of data, but it would be really nice if the SEC would mandate 20 data points that typically every user or every investor would find interesting. And I do find the debate around materiality and we should be fully comprehensive a challenging one, because I think a first step would be just give 20 data points. I mean, there's not a mandatory reporting around employee turnover at this moment. I find that really hard to believe, that there's not a relevant issue for at least 70% of the companies. So maybe that's where my argument comes in as a practitioner that looks at this data. I would argue that having broad sets of data is important, but why don't we just start with 20 data points that for every company is relevant? And we could argue about which ones they are, but something tells me they will be and material and they will be sustainably important for many stakeholders.
Laura, you get the last word.
Well, actually, I wanted to get Jeffrey Hales, who's a professor here at UT Austin, and he's chairman of the SASB, Sustainable Accounting Standards Board, and to get him to answer that last question.
Jeffrey, you have the stage.
So, I think that there's definitely a role for assurance. But I think it actually it all takes a system. I think that information is a public good. Put it out there into the public domain. It will be used by a variety of users in a lot of different ways. But we'll be looking to ratings agencies like Sustainalytics to provide insight and incremental value there, analyzing a public set of data like that. The higher the quality, the better and more useful it will be. I think there's a lot of potential benefit, but it's great to see the interest in research on this, and I think there's it's a huge growth area. All the big four have invested a lot in trying to build out their advisory functions, assurance, tax. So it really is a growth area in the profession, and I think we're going to see a lot of change. So it's exciting. I just sort of would leave it at that.
Great. Well, thank you, everyone. Lots of wonderful information in this session and great questions. So hopefully we'll see lots of new papers coming out from you all answering these important questions that the panelists raised. Have a great evening.
Thank you.
All right. Bye-bye.
Thank you very much. Have a nice evening.